We are NUM Titans. Under the current market uncertainties, we have identified a timely investment opportunity. Mandal is a leading general insurance company in Mongolia, backed by Gothland Financial Group, who owns Mongolia's largest urban retail bank, Gothland. Mandal is distinguished among its peers with its active investment strategy, well-managed reinsurance policy, and balanced underwriting. We, NUM Titans, issue a buy recommendation with a target price of 59 MNT representing 23% upside potential. So, why buy Mandal? 1. It has a prime position in the market with efficient business model. 2. It has growth potential supported by resilient product development. 3. It has high profitability backed by healthy financials. Let's start with the first point. Mandal is always ahead of its peers, disrupting Mongolian insurance industry, as it has introduced banking brokerage in insurance, became the first insurance company to go public and get international credit rating. Even though Mandal is the youngest among its peers with only 10 years of experience, Mandal has established leadership in the market by its total assets, investments, and net profit. Mandal reached this success with its excellent management team and strong corporate relationships, becoming a trusted insurer of Mongolia's largest firms. Third, Mandal has a solid income source from its related party, Gothland Bank. Banking brokerage accounts for 42% of insurance brokerage. Gothland Bank comprises 1/5 of banking brokerage, which Gothland solely transfers to Mandal. Gothland's brokerage accounts for 15% of Mandal's premium income. Lastly, Mandal has the largest investment assets among its peers, more than double the industry average. Also, Mandal's investment return is 1.5 times higher than industry average return.
Let's look at Mandal's growth potential. First, Mongolian insurance industry penetration rate of 0.5%, which is 4.5 times lower than penetration rate of emerging Asian countries. This shows how underpenetrated Mongolian insurance industry is. Second, Mongolian insurance sector has shown consistent growth over the past 6 years with 2% CAGR growth of penetration. We expect this trend to persist in the future. Our analysis showed that 1% increase in economic growth leads to 3% increase in insurance industry growth. With that in mind, we forecasted insurance industry premium based on economic forecast of International Monetary Fund with average growth of 14% post-COVID. This is higher than the growth of emerging Asia's general insurance industry. Here you can see that CAGR growth of insurance premium surpassing the CAGR growth of economy. When we analyzed insurance products by their market shares and growth over the past 5 years, automobile, casualty, and private health insurance emerged as the fastest growing high-demand products. Mandal integrated this growth into its business strategy with its best-seller products, Songot automobile insurance and Jarlon private health insurance. With Gothland Bank's brokerage, Mandal captures casualty insurance growth. Therefore, we expect Mandal to increase its market share for these growth strategy products.
Can Mandal benefit from this growth? We say yes. Mandal is the most efficient company among its peers. When we analyzed the operational efficiency of top 7 insurance companies in terms of net profit and market share, Mandal resides in the most efficient region in the matrix. So, how does Mandal operate this efficiently? Because of 3 points: high margin products, active investing, and efficient reinsurance policy. These will lead to 22% growth in Mandal's net profit and 25% in net profit margin by 2025. Mandal strategically focuses on casualty and automobile insurances, which have the lowest loss ratio and reinsurance transfers, leading to high margin. Not only that, Mandal maintains low loss ratio thanks to its efficient underwriting risk management. Moreover, Mandal excels in investing. diversifying its portfolio among bank deposits, fixed income securities, and stocks, enabling the company to earn a high return of 16% while maintaining its risk exposure. We believe Mandel can surpass this success with its sound investing committee and expert investing personnel. Third, we expect Mandel's equity to grow at 25% CAGR, which in turn will increase company's risk retention, further fortifying its profit generation. As a result, Mandel's return on equity will become 26% by 2025. This is due to the significant increase in equity resulting in lower asset turnover. But we firmly believe that Mandel's net profit margin will increase alongside its operational efficiency.
Now we know that Mandel has an impressive growth story. Now, let's take a look at the numbers. We used weighted average of residual income model and relative valuation approaches, which leads to 23% upside potential. For residual income model, we used 22.5% of the cost of equity and 4% of the terminal growth rate, which indicating 39% upside. For relative valuation, we compare Mandel to 8 other similar companies which operate in under-penetrated general insurance industries in emerging Asia. We use P/B and P/E ratios, indicating that Mandel is undervalued. Sensitivity analysis on cost of equity and terminal growth rate upholds buy recommendation and shows limited downside. Our target price is more sensitive to cost of equity and economic growth rate. To complete our analysis, we identified potential investment risks. Today, we will focus on 2 main risks. First, economic slowdown. Industry premium income growth is highly correlated with economic growth rate. And from our analysis, 1% drop in economic growth rate leads to 1.5% drop in our target price. But we believe that Mandel will mitigate this risk by its high investment income and balanced underwriting revenue. Second, interest rate downside. In last year, bank deposits account for main portion of the investment portfolio and 65% of the investment income. So Mandel is exposed to interest rate risk. But we believe that Mandel will mitigate this risk by its investment diversification strategy.
Let's take a broader look into the company. In ESG analysis, it's important to consider materiality. We integrated MSCI's materiality map for general insurance companies into Mandel's case and chose following ESG issues. How does Mandel manage these material ESG issues? Here's how. When it comes to treating its customers fairly, Mandel offers efficient and timely customer service, along with constant risk prevention measures. However, Mandel has the highest number of unjustified refusals to issue claims, as reported to FRC. Thus, Mandel has moderate management for fair treatment of customers. Mandel maintains excellent human resource management and community engagement, and sufficient management over privacy and data security. As the company does not disclose ESG policy and implementation, we have no information on how Mandel considers ESG principles into its investment process. We evaluated Mandel's corporate governance as good, with excellent shareholder rights, and as well as good management and board. Thus, we conclude Mandel has moderate ESG management. To recap, we recommend a strong buy recommendation for Mandel with 23% upside at target price of 59 MNT by the end of 2021, considering 1. Mandel's prime position in the market, 2. Mandel's growth potential, and 3. its high profitability. Thank you very much.